Good morning, everybody. Good morning. My name is David O'Neill. I'm the President of Corporate Connections Canada. Delighted to join today with our latest session of our Canadian Speaker Series. Today we're joined by Colin Keddy. Colin is Managing Partner at Synergy Family Office based in Ottawa. Perhaps I can take a moment to introduce Colin. Many things I could say. I would start by saying that he is an award-winning financial planning professional. He has over 20 years experience in the Canadian financial sector. He's a writer and contributes regularly to, I believe, at least two national financial publications, as well as other things. Outside of business, very active in local mission outreach, international aid work, so really about meaningful change in terms of communities and lives with people that he helps, both professionally and personally. In terms of his clientele, both national and international clients, including some professional athletes, individuals in the media industry, and I think his approach is very interesting because he really uses a team of experts to help measure the efficient and effective accumulation and distribution of wealth. So it's about really making his clients confident with regards to the decisions they're making, including innovative but proven strategies. So today's subject, really what we wanted to ask Colin to talk about is in the context of COVID-19. Many governments around the world have initiated, in some cases, quite substantial stimulus packages to help both businesses and individuals. That's certainly the case in Canada. Of course, one of the consequences of that is we see national deficits increase significantly. So there is a cost, and at some point there will be a responsibility, sovereign responsibility, to pay off these debts. And Colin's going to talk a little bit about what that might mean for the Canadian taxpayer, for us as business leaders and business owners, and how potentially to plan ahead with regards to tax deferral and elimination strategies. So Colin, welcome. Thank you for joining us today. It's great to have you on, and
Thanks,
we're pleased
David.
to have you here.
Appreciate it.
Thank you. And just for our listeners, those that may not be regular, we will have about 30 minutes with Colin, followed by a 15-minute question and answer session. This session is being recorded. And we invite all attendees to put any comments or questions either into the chat bar or into the Q&A button at the bottom of your screen, unless you are using a mobile device. So perhaps just to kick us off, Colin, you can tell us a little bit about yourself with regards to who you are as an individual and your background in the financial industry here in Canada.
Okay, well, let's see, what can I tell you? I was born at a very early age. Well, as far as my career is concerned, I've been in the financial services now for about a quarter of a century. My start in the industry was relatively humble beginnings. I worked for one of the big houses, more on the insurance side, typical type service for the family market, investments, insurance, that sort of thing. Early in my career, probably around the 5th or 6th year that I'd been in the industry, I got an opportunity to start working with some really high net worth clients. I got involved in some very complex tax planning strategies. I was a big fan of planning software and tax planning software. So I really developed a niche in that space. And so that's where my efforts became focused and really working with high net worth clients and focusing on specific solutions for their situations.
So now, obviously, you run Synergy Family Office, which is very successful in the Ottawa market and beyond. But for the benefit of those listening or attending that may not understand the concept, perhaps you can explain a little bit about the family office as a concept, and in terms of the value that you're able to give to clients and how this might relate to others on the call and their situations.
Sure. And it's a great question. Very often, sometimes people will say family office. They'll think that I'm actually in the medical profession, thinking it's a doctor's office or something more related to that. But the concept of family office, I guess there's two ways to look at it. The typical family office would look after, say, one high net wealth family. Chances are today that would be probably in excess of $1 billion. The type of structure that mine is, I'm actually a multifamily office. So multifamily office would support a number of families. So instead of having all these professionals that one single family was bearing the expenses for, we look after a number of families. So for our office, we've decided to max out at 35 families. That's where we're sort of trending towards right now. And as far as what we do, yes, there's the typical, financial investment side, insurance, but we get into everything in respect to estate planning, risk management, objective financial counsel, what's referred to as family governance. We deal with different lifestyle, coordination of all the different professionals that are involved. So basically anything that has to do with that family's wealth or virtually anything. And even from a multi-generational standpoint, we're coordinating all those different efforts together for the support of the client. And so more typically, even in the space of a multifamily office, it would be servicing $50 million and up. When I had left the former company that I was with, I sat down and really looked at, what I thought was capable. And, we really felt that we could do that same service or provide that same service as the ultra high net worth to what I kind of refer to as today's more mass affluent. So our typical client runs in about the 5 million of net worth to 50 million of net worth. So it's not really based on invested assets. It's more based on, what their overall financial situation is. So, and when someone comes into our office and, they're trying to get a concept of, what this is, what does it mean? I mean, one very calming question that I will ask someone, we'll be sitting at the boardroom table and there'll be a bunch of empty chairs there. And the question will be, if you're accountant, your lawyer, your insurance investment advisor, or all three of your insurance investment advisors, you have to have three because you couldn't trust any one of them to manage all of your money, your banker, mortgage broker. If all of these people were sitting here and they were talking, they were all here representing you, do these people even know each other? And more often than not, these people have no idea who the other individuals are. They work in complete isolation of their own space. And so 99% of the time, clients are saying to me, no, these people don't know who each other are. And so what I'm saying to them, the concept of the family office or multifamily office is, well, let's bring these people together. And if we could get them coordinating, if we could get them communicating with each other, isn't there a good chance that, we're going to be able to do far better work on your behalf? So that kind of gives you a bit of insight as to what the concept of family office is.
Perfect. Thank you. And so, I imagine you have, I don't imagine, I know you have many different skill sets with regards to, I guess more the technical side of your role. It strikes me as well that it's got to be critical to your success to gain the confidence of your clients trust that your firm is making the right decisions on their behalf. So in terms, I guess, of where we are today in Canada, how do you see the current state of the economy, the current state of markets, where we have, a very buoyant stock market and perhaps less certainty elsewhere? How do you see all that affecting decision making going forward as it relates to your clients' needs?
Yeah, well, certainly, I think in the general perspective of, again, family office, multifamily office, what they're doing, I mean, these people are generally avoiding risk in the first place. So I think what's worth noting about that, as far as where we are right now, the two major issues are, what is the future of taxation, and the issues as it relates to volatility. So, I mean, I'm certainly not an economist, but one, and I've had lots of conversations with, different accounting firms and CPAs and economists. We're printing money. You've got huge amount of subsidies, bailouts. sooner or later, this money has to come from somewhere, right? So, does it come in the form of taxation? Is there some alteration to existing benefits, whether that's CPP or OAS? Something's going to happen. So no question in respect to taxation, I think we're all very hypersensitive to, how are we going to manage that? I mean, most people connected to family offices, these are things that they're constantly worried about. But I think this is something that, as far as, if there's any value for those who are listening, I mean, no question that we should be, very considerate of where that's going to take us. And then on the side of volatility, no question, here we are, major volatility with the TSX. I mean, it's rebounded a bit here now, but at the mid-March, the whole 5 years of gains, we're gone. So volatility puts a massive pressure on money to perform. And where it's really scary, is the individuals once you become a consumer of your wealth, right? So if whether you're taking that money monthly, quarterly, or annually, if you've got volatility going on, you've got taxes, that's a lot of pressure, especially with volatility. If the market is fluctuating up and down, and let's say, for whatever reason, you needed to pull money out in late March of 2020, that would have been a significant loss. And so volatility is really not your friend. Sort of anecdotally, I had a client of mine who played for the New York Rangers, and he was on a mission to bank himself $10 million, and he said, from that $10 million, if I could have $750,000 of annual income, I would consider myself fine. And looking at the, even just the index over a long period of time, whether it's 10 years, 20 years, he's like, I know that the average return is generally above 10%. And I said, well, yes, that's the case, and you can benefit from that going in, but on your way back out, it doesn't tend to work that way. More often than not, you're going to be drawing down on this money, and you're going to have some up years and you're going to have some down years. The problem with volatility, and especially like what we're seeing right now, and you go into long levels of uncertainty, that $10 million all of a sudden, say, is $7 million, and then he's then drawing against it. And interestingly, in his particular case, I said to him, choose any 30 years over history, and we'll run a model to see what drawing down on it looks like. And virtually any time over a 30-year period at $750,000, he ran out of money. So even though the market on average is higher, this volatility issue and then long-term volatility issues are not your friend when it comes to receiving money in the retirement stage. So yeah, there is no such thing as dollar cost exiting. So volatility and taxation is massive concern right now.
So just talking about perhaps the taxation side, first of all, I know that a lot of professionals are focused on strategies with regards to tax deferral. And one thing that I found interesting from our conversations is the notion of tax deferral versus tax elimination. And clearly tax elimination sounds more attractive to many of us, but perhaps you can just give us a little bit of insight into what the difference is between those two types of strategies and how they could potentially impact some of the business leaders, business owners on this call.
Sure. And I think it's, I mean, just by the sheer nature of, tax deferral, tax elimination, it's relatively clear as to what they are. The question really becomes, how do you use these things? So starting with the deferral side of things, obviously the most common thing that, we see here in Canada, would be the RSP. You put the money into it, you're provided an incentive against the income that you receive. But eventually that money is going to become income back to you again. And so tax will be paid. So, and life has changed a lot since RSP came out. So in 1957, when RSPs were introduced, the typical individual, whether they were high net worth, or even sort of, we'll say, mid-market wealth, is their income was, say, up here, and then by the time that they had gone into retirement, back when life was simpler and we didn't have the level of expenses that we did, the expectation was that you would retire on a, maybe not a fraction of what your income was, but you would certainly retire with less. So the idea was that at retirement, you'd be in a lower tax bracket. And that totally made sense then. But we're a long way from 1957, and things have changed considerably. So we fast forward a bit today, and again, when I talk about what I refer to is the mass affluent, I'm seeing individuals with $1 or $2 million of assets. Not necessarily all RSP. That could be broken up between RSP, TFSA, non-registered income. And on top of that, obviously at age 71, this deferral mechanism is now, forced into income, and they've got that RSP income, they've got CPP, they've got OAS, maybe they've got a pension from work, maybe there's money coming from non-registered investments that they have. So it's not unusual to have 3 or 4 sources of income, and all of a sudden, this concept, like I say, the way it was in 57 of retiring with less, they've actually retired with more. And so I can certainly tell you firsthand experience. I've seen clients who, save throughout their whole life, RSP contributions that, we made, 10, 15, 20 years ago were made more in the range of about a 40% tax bracket. That very same client now is retired. And like I say, a couple $1 million, multiple sources of income. He's actually in a higher bracket than he was when he was making the contribution. So here he is now at top tax bracket in some cases, all the way up to 53. So that would be sort of your quintessential deferral. But again, eventually the piper is going to come and you have to pay it. So elimination is pretty straightforward. If you saved money in some fashion, and then when you retire, you're either paying very little income tax, you've lessened that, or you've eliminated it altogether. As I mentioned, early in my career, I started working on a lot of different tax planning strategies. And so one of the big focuses was insurance as an asset for the purposes of tax-free income. And I think for many people, when they think about life insurance, they're like, okay, we're talking about life insurance. How does that affect, what's the benefit for me as far as any form of tax elimination? We think about, okay, well, insurance, it'll cover my future income, or maybe the tax elimination is on my estate liability. I know that there's going to be income tax when I pass away, but we're using that insurance to create an income while they're alive. And in doing so, insurance can actually be set up to provide virtually tax-free income.
So that's an interesting concept, because obviously I would assume that almost all of us do have life insurance policies in place with the goal to maximizing the assets that we can pass on to our estates. But what you're saying is you can use insurance to actually reduce that tax liability. Let's say it was up at 53% when you retire. You can eliminate your tax liability through the use of insurance whilst you're still alive. How's that possible?
Okay, good question. So first, I will say this is not every single insurance that is out there. If you do have insurance, certainly it's going to depend on what type of insurance it is. Which probably won't get into the details, but just to answer your question, yes, there's definitely some very unique characteristics as far as what you can do with insurance. Maybe the simplest way to do it, I'll give you kind of an example. So let's assume that we had someone who was looking, they purchase a $5 million insurance policy at the age of 50. Okay. And let's say that there's 10 installments for that insurance policy, and the installments are $250,000. So not an insignificant amount of money, but again, I want to use something substantial so you can get some perspective of the amount of income that it can
Mhm.
create and on a tax-free basis. So we made 10 installments. That money, goes in over a course of 10 years. Chances are, 10 years from now, we've put in $5 million of actual cash. The insurance policy, now worth $10 million. It's nearly doubled. And again, as I say, for most people, that perception would be, okay, that's great. Even if I have cash value or I have insurance, I've created a benefit for somebody else. So we'll look at it through a little bit of a different lens. And so let's assume that, over somebody's lifetime, that $5 million policy in all likelihood is going to, triple or quadruple as far as what the value is. So, that's going to go, that same $5 million is going to go to $15 million or $20 million in tax-free. Now, regardless of what insurance it is, all insurance is paid out tax-free. So, and maybe what we'll do is look, instead of just saying, okay, well, I'm going to leave that life insurance for the purpose of my estate. Maybe you could look and say, well, could it be leveraged? So, and in the same way, let's say if you owned a property, okay, if you owned a building, you owned a house, and you didn't actually sell that property, but let's say that you wanted to reach in and take the equity out of that property, you could take the equity out in a form of a loan. Okay, so if that house was worth, or the building, will say, was worth $10 million, and you wanted to reach in and take some of that money out, if you haven't actually sold that building off, you haven't triggered any gain. So you've created a loan, which is not considered income, and that money, whether you take it out as an income stream or you take it out as a lump sum, invest that lump sum and create an income stream, the money that you're taking out is considered a loan and not considered income. So just by its very nature, you would not owe tax on the money you borrowed out of that property. Sure, the mortgage company that lent you that money, they'll be looking for an interest rate, but certainly I think it's fair to say that, say, a mortgage interest rate or a loan interest rate is going to be far more feasible than, say, 53% income tax. So if you can do that with property, why couldn't you do that with insurance? And certainly insurance has, every bit of value that a property does. I mean, it's virtually the same thing. A lot of people go to banks, they use insurance as a form of assignment to protect liabilities that they may have with their bank. So, why not do the same thing?
So essentially, you're drawing down on the future value of your insurance policy, given that it's going to grow in value in a tax-efficient manner, because you're not going to be you're not going to be paying 53%. You're going to be paying whatever it would be in terms of cost of borrowing, whether it be on the asset. So that's interesting. I mean, just I'm looking at the time, Colin. Maybe you can give us another example of what you're doing, or what business owners can do outside of insurance to drastically reduce their tax liability, or even eliminate it altogether. You mentioned
Yep.
RRSPs earlier, and it is one of the most common methods of tax planning. But what
Sure.
else can we use? What else could we have in terms of a strategy to eliminate our tax liability?
Sure. So going back to one of the things that we were talking about earlier in the conversation, which was the RSPs, and so a great example of something to talk about, given the fact that that's where probably 80-90% of the invested dollars in this country are. So one of the things that I've been doing for the past decade, which quite frankly is based on tax planning strategies are based in the Income Tax Act and been around virtually for the last 100 years, is the concept of borrow to invest, interest deductibility, and the fact that you're allowed to have a personally owned mortgage. So in the 80s, way before your time, interest rates, it was not unrealistic. You had really high double digits for people to get a mortgage on their house. So using those aspects of the Income Tax Act. Some accountants were setting up for their client and saying, hey, maybe you didn't qualify for the full amount of mortgage. Let's subsidize your mortgage by taking your RSP, lending it to yourself. We'll meet all the criteria because, like any good strategy, CRA is looking at all of these things. So, I mean, nothing that we're talking about here is, bleeding the lines of CRA. Let's be realistic. Anything out that's out there, they're going to look at, they're going to scrutinize. And any time that we look at it, either we've got opinions or we've got advanced tax rulings. So these are not ideas that we're just simply playing jazz with. So again, we're taking what people were doing back in the 80s as far as lending themselves that money. Fast forward to today, and we've got something else to add into that. We've got the TFSA. So what if I could set up a mortgage strategy where I'm incorporating the TFSA and the RSP into it, where I'm creating this, say, self-directed style mortgage? And is there a mechanism that, I can reduce my tax? So again, very difficult to try and verbalize this in a call like that. But in answer to your question, we are actually doing what is typically referred to as an RSP meltdown style strategy. And then we are redirecting that money back to the TFSA through one mortgage, combining those two instruments. And again, maybe a little bit too difficult to verbalize in a conversation like this. But what I can tell you is that, simply put, at the end of this mortgage process, and sometimes it takes 5 years, 6 years, 7 years, 10 years, we are actually converting the RSP into TFSA. And I'm not suggesting that the tax doesn't exist, but because it meets the borrow to invest rules and the deductibility, we're ending up with a dollar for dollar deductibility to do that offset. So, imagine someone, say, 50 or 60 years old, now coming to, age 71, where they're forced to RIF, and there is no RIF. All that money is now TFSA. And yes, there is limitations on what you can put into TFSA, but there is not, I shouldn't say there are no limitations on what you can earn. Simply put, the strategy does work. It's not an overnight success, but we're able to hugely eliminate income tax from the RSP that way, which again just has rolls over to things like the loss of OAS or increased income tax in other situations. So it's just a great method of depleting taxes all around.
So essentially, the borrow to invest allows you to deduct the interest. You can use the RSP as an instrument at a low interest rate, and essentially reimburse into your TSFA and deduct the interest liability. Therefore, when you retire, you're not going to be potentially as liable to go up to 53%, but you're lowering your tax burden because you don't have a large amount of RSPs at age 71 or whatever it is, which is super interesting.
On a mortgage that you've created for yourself. So as long as you trust yourself to pay your own mortgage, and you do have to follow the rules, that's exactly it. And as I say, we talked about volatility. Here's a mortgage done to yourself. Obviously, mortgages in general have, little to no volatility. You've removed all the commercial risk because you're lending to yourself. So it's eliminating the tax, but it's also not creating a greater risk of doing so because you have no commercial exposure.
Interesting. Very interesting. And obviously that actually does liberate cash because you are borrowing to invest. So you actually will have investable assets at the same time that you're unlocking through this mechanism. Colin, we're running short on time. Let me ask you perhaps one last question before we finish. As a takeaway, can you give us one basic principle or practice that people can apply in their everyday life as it pertains to financial planning?
Yeah, absolutely. If I see people, there's not always an expectation that they're coming back to the office. And so I say to them, listen, whether I'm the right fit for you or it's somebody else, here's your takeaway. So I'll give you the same takeaway I give everybody I meet for the first time, which is based on what? That's the question. That if someone says to you, hey, you should do this, you should do that, do RSPs, don't do RSPs, I don't care what it is. Any type of financial advice that somebody offers you should have some source of mathematics that back it up and explain how it's effective for you. Unfortunately, we live in a world of opinion, and everybody's got one. And there are a lot of strategies that do apply to many different people. But I think what people really need to do is, where's that supporting math as it relates to me? And the great thing about math is it generally doesn't lie. Last time I checked, 4 + 4 was still 8. So uh, that would be, that would be a real key thing. And, it's interesting and going through some of these strategies and, really have an open mind to what you're looking at. If somebody can present something to you, and as I say, whether they've got, supporting evidence through whether that's an opinion or it's advanced tax rulings, keep an open mind to what's out there. I had someone once say to me, hey, if all these strategies were so effective, I think that everybody would already be doing this, to which, my reply was, well, the last time I checked, only 1% of the world had all of the money. So I'm really not trying to replicate what everyone's doing. I'm trying to replicate what that 1% is doing. So follow the math. The math never lies. That's my advice.
Makes total sense. I mean, it's interesting because last week we were talking with Martin Aquilina a lot about the notion of gaining confidence, obviously in the context of doing business internationally. And I think this is the same thing. The more we can have confidence based upon the fundamental data of what we're being proposed, the more we can actually understand and perhaps prove the benefit of the decisions that we're making. So for me, it all comes back to having the confidence we're making the right decisions to benefit us as individuals, as business owners, as family leaders, and so on and so forth. So Colin, time is already up. In fact, we've gone over a little bit. So okay. Thank you very much. I think we could have gone on for quite some time, but
I get paid by the word, so.
Well, then we're definitely cutting it off right now and passing it over to our Vice President, Trevor Botkin. Trevor, if you'd like to take over. The next portion of this obviously will be the question and answer portion of the session. And Colin, thank you once again for taking some of your time this morning.
I wish I got paid by the word. I would be far more wealthy than I am now. Yeah. Thank you for that, Colin. And we're just going to dive right into the Q&A. And again, hopefully more questions come in. If not, I certainly have my own questions. But the first one would be, what are your thoughts around individual pension plans versus RRSPs?
IPP, well, they're quite similar. And I say, when you say individual pension plan, I'm assuming we're talking about what someone would set up for themselves inside a corporation. Again, I guess the difficulty, I don't dislike them. Again, with the fact that we can utilize the strategy I was talking about with a self-directed mortgage to then transfer over to TFSA. You can actually marry up an IPP with that strategy. An IPP is a deferral mechanism. So, it's good. It allows for greater money beyond RSP. But again, it's a suppression attack. So I don't dislike it. I think, again, you just have to look at that long-term aggregate of going, okay, what will I have in the future to whether I can offset that liability? Will I actually be in a lower bracket when I go to consume that IPP, or will I be equally as high, or possibly higher?
So again, coming back and probably looking at it from a math formula and just making sure that you're running the numbers, and is it the right solution?
Right. And unfortunately, with any of those things, most people only look at it in the accumulation stage. What's it look like? How big does it get? But it doesn't matter how big it gets. The only part that matters is when you receive it, what's it worth on a net basis after tax? Okay. And did you lose anything else in the process? Like I say, OAS could be clawed back because of, heightened taxed income.
Great, great. And are there lower tax jurisdictions that you would recommend for the reduction or elimination for Canadians?
You mean, would I suggest that someone move from one province to the next to lessen their income tax? Well, certainly there's a little bit of variances throughout Canada, but quite frankly, these things that I'm talking about are unilateral, and if you can implement them in any province, so it makes no difference. It's not a product; it's a strategy. Um, so yeah, I actually did a few years back had someone who was moving at the time from Ontario to Alberta because uh, the tax jurisdiction was less by about 10%. I don't know how everything's faring, there now. I suspect that probably his income tax level hasn't changed, but I don't. I think I would be invoking more strategy work than I would be moving provinces
Okay.
to chase a lower rate.
And then again from George, how best to minimize capital gains tax on selling property other than the principal residence? So I think for a lot of people right now, when they're looking at their properties that maybe they're sitting in their portfolio, is there a way for them to be, minimizing those capital gains?
Yeah, and I think it's it's a good question. It's a good question, and I think the other thing that I think people should be really conscious about right now, with the whole issue of this printing money and everything else, is what is the future of capital gains. So, the Liberal government has talked about for a while, whether it's the doing away of the personal exemption, or it's changing the capital gains rule from 50% to either eliminating or increasing it. So one aspect I would very much consider. I'm doing this with a client right now, where just purely as a hedging strategy, we're selling we're selling property and incurring that capital gain right now. And so there are different things that people can do as far as, again, you may have some carry forward that can be applied against that. Um, Difficult to say, not looking at it at an individual situation, but in a very generalistic term, I would be sensitive to capital gains right now. As the reality is, it could very much change here in the not too distant future. But happy to have a conversation to look at it more specifically for someone. You're muted, by the way.
That's awesome. It's my first Zoom call of the day.
Yeah, that's okay. I like your
Um,
vest, by the way.
I am just trying to keep up with you. Look, so, and again, I think right now the question that it's a conversation I'm having with a lot of different people, and they're asking me, which is probably the wrong person to ask, but looking at the current markets, looking at what's happening, looking at real estate prices, looking at 2008, looking at the depressions and that. Where should people be thinking about investing, or what's the safest strategy right now in terms of hedging bets of what may or may not happen in the coming 6 months, 2 years, and that? And is there anything that people can doing, regardless of kind of where they fit within, high net worth, or, in my case, low net worth, where should people be thinking about their, putting their money right now?
Yeah. Well, we're all subject to some level of income tax, whether you're paying 53 or not. Paying 40% income taxes is not nothing. So my answer to that, and again, I guess I have the bias of being a planner, but what I would generally say to people anecdotally is, you know, first sit down and look and go, what's the best way that you can organize your situation to minimize tax? Like, let's say for argument's sake, that over the next 20, 30 years, you could decrease your income tax level by, let's say, 8%. Okay. So if you could decrease your income tax level by 8%, and, let's say that you could get a modest return of 5%. Again, looking at what the current circumstances are, you see lots of volatility. Hey, maybe we won't chase these returns. Maybe what we'll do effectively is, reduce our income tax by 10%, get a 5% rate of return, in out in, whether it's in the market, and again, we're not even going to go down the road of this, but you've got the publicly traded, you've got the privately traded. Let's just talk about maybe making some more conservative choices. Again, shooting for that 5%. Well, if you could eliminate 10% of income tax and have a 5% rate of return, you get an effective rate of 15. And I can tell you that, these are no secrets. What are the ultra high net wealth doing? It's wealth preservation. They are not chasing return. I remember in the correction or 0809, one of my mentor who managed a $4.2 billion fund, I asked him, how far down is that, $4.5 billion, not really portfolio, but your client's position? He said, Colin, we're maybe down 1% because we're not where these other people are. We're mitigating tax and we're preserving capital. So I would really challenge people to say, okay, what is the most risk-free decisions that I can make? And let's minimize the tax. Minimizing tax is mathematical. Chasing risk is purely hypothetical.
And so I guess my last question then, should we be looking at, if we're investing or if we're looking at where we should put our money, is it in assets in terms of that? I mean, if someone was asking me, should they be buying gold? Should they be buying property? Like what's the safest place to put maybe that money, of saying, I just don't want to lose money. I also just don't want it sitting in a volatile market right now.
Yeah. Well, I mean, there's a number of eroding factors when it comes to losing money. So what you have to keep in mind is dealing with the fact that you've got inflation, you've got income tax, just even the consumer propensity to spend. Years ago, I read something where they're talking about, technological inflation. I mean, you didn't have a cell phone bill, you didn't have internet and all of these Netflix and everything else. Your technological costs for most people represent 1% to 2%. So where can you put that money that it's completely safe? Well, chances are your money needs to earn 5 or 6%. So there is no surefire, there is no risk to this. So that is an issue. There are a lot of opportunities that are not publicly traded. There's a great auto fund. I don't know if we've talked about this subprime auto fund debt, which I happen to own. No, I'm just kidding. So there's a lot of off-market fixed returns. They're certainly not all equal, but if you're really concerned about volatility, and I understand that, we have a very sticky stock market. They're due to the fact that there are actually more mutual funds than there are securities. The whole market is stuck together. So when the whole thing moves, it all comes together. So when people are asking the question, is it property? Is it this? Is it that? Well, one, if you're buying that security on the publicly traded market, chances are they're all moving in one direction. I mean, we're seeing, REITs, and even I realize that obviously there is some issues as it relates to, say, commercial buildings with office tenants, but we're seeing REITs that, apartment buildings, they shouldn't be having a setback right now, but the whole market is so very sticky and it's fluctuating right along with it because that's just the nature of the way that it works. So I would definitely be considered looking at, a security that, is off market with a fixed rate of return, be that a debenture. But again, I'd be trying to look for 5%, because in socking that money away at 1 or 2%, you are losing money.
Beautiful. Look, we're pretty much out of time for me to ask the questions, so I'm going to turn it back to David. But certainly, I thank you for your time, and thank you for your candid answers. Yep. David?
Thanks, Trevor, and thank you, Colin. Next time I shall endeavor to adhere to the dress code, which I didn't really get the memo on today with regards to your fabulous waistcoats. But thank you for running that session. And thank you, Colin. So this is now the end of this week's speaker series. It's 11:45. Just to give you all insight into next week's, we will be having Anthea Sargent. So we'll be moving from the east side of the country, Ottawa, to the western side of the country. Anthea is the CEO of 2S Water based in Edmonton, fabulous company that looks at automating water purification. So there's a whole bunch of end uses for that, as you can imagine, with regards to sustainable development across the world. in terms of what we'll be discussing, it's really about how established business owners can take advantage of the situation right now and create a culture of having a mentality of startup. And what are the benefits of that? It's about agility. It's about embracing innovation. It's about embracing risk. And also the authenticity that many companies are showing right now with regards to their CSR, their corporate social responsibility. So how can we as business leaders of established businesses embrace that startup mentality to effect significant change on our companies to allow them to thrive and prosper once COVID-19 is drawing to a close. So looking forward to welcoming Anthea Sargent, CEO of 2S Water, next Friday, 11 a.m. Eastern. And just to thank today's speaker, Colin, once again, really interesting insights. It's not easy to take a technical subject like that and verbalize in this type of call. I think you did a great job, and I know there's a lot of value for all the attendees. So thank you, Colin, thank you, Trevor, and thank you to all our attendees. Wishing you a fabulous Friday and a wonderful weekend, everybody, and we'll reconnect next week.